Coming up on Market to Market, the coronavirus extends its shadow over the economy. The EPA sets a different path on ethanol.
If the majority of the
And commodity market analysis with Elaine Cub next.
All of the milling wheat in North America.
Pioneer Hybrid International is a proud sponsor of Market to Market.
Sukkot Manufacturing Company, providing equipment and buildings to store and condition grain to help farmers adjust to market swings. We build drying, moving, and storage equipment designed to preserve the quality of their crops. Sukkot Manufacturing, store now, profit later.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. This is the Friday, March 6th edition of Market to Market, the weekly journal of rural America.
Hello, I'm Michelle Rock. Paul Yeager is on assignment. The stock and commodity markets have spent the week sizing up the impact of the coronavirus. Congress passed a bill putting $8.3 billion towards the battle with COVID-19, and President Trump signed the measure Friday. Peter Tubbs has our coverage on the impact of the coronavirus on everything from domestic goods to agricultural products.
The continually expanding economic shadow of the coronavirus reached around the globe this week.
What we are wrestling with is uncertainty, and that defines our projections, which at this point lead us to state that global growth in 2020 will dip below its last year's levels.
2020 global GDP growth is estimated to hit 3%. The United States saw 2.3% growth for all of 2019.
What we know from experiencing similar crises is that about 1/3 of the economic losses from the disease will be direct costs from loss of life, workplace closures, and quarantines. The remaining 2/3 will be indirect, reflecting a retrenchment in consumer and business behavior and a tightening in financial markets. In other words, the impact of uncertainty.
Economic retrenchment can be seen in parts of China as residents shelter at home to avoid the virus, which first appeared in late December. The fear of public spaces has slowed factory production in the country, which is now rippling outwards into countries that depend on low-cost Asian labor for economic advantage.
Zenni's manufacturing model is completely reliant on Chinese production, and so any slowdown or work stoppages there affect our ability to deliver on time to our consumers.
West Coast ports are also seeing a slowdown in container traffic.
For the month of February, we're projecting that we will sustain another 6% decline year over year. We attribute all those declines to the coronavirus situation that's emanating in China.
Airlines around the world are reducing scheduled flights in response to a drop in travelers and have canceled trips on routes to areas with high rates of infection. As of Friday morning, the CDC is reporting 99 confirmed cases of coronavirus in the U.S., with 10 deaths. The slowing Chinese economy has raised doubts that the $40 billion in agricultural trade promised in the recent Phase 1 agreement will be purchased. Secretary of Agriculture Sonny Perdue tamped down questions of another round of market facilitation payments.
I'm telling farmers to do what they've always done and plant for the market. I'm telling farmers that if we get the export, we get the trade, and we don't see prices increase, then market facilitation program was not a price support program. It was a trade disruption program, not price support. So if we see trade increase and prices don't go up, that's a market signal to farmers who are producing too much.
For Market to Market, I'm Peter Tubbs.
The U.S. economy is in its 11th year of expansion. COVID-19's recent effect on overall growth has been under the watchful eye of the Federal Reserve. This week, the Fed cut interest rates a half point to help contain fallout from the virus. Despite the move, Wall Street had a volatile week, finishing barely above a week ago Friday's close. Before the coronavirus began to sweep through the country and the economy, 273,000 jobs were created. The unemployment rate fell back to a 50-year low of 3.5%. The 9-state Mid-American Business Index fell 7% as supply managers reported negative impacts of the coronavirus. The index is still above growth neutral despite the drop. For nearly 5 years, the ethanol industry has been battling to keep its share of the motor fuel market. President Trump has publicly supported ethanol and had a handshake agreement with the ethanol industry to preserve federally mandated blending levels. That deal has been largely ignored by the EPA and has only served to anger ethanol farmers. Josh Bittner has more.
Decide the right path forward.
This week, EPA Administrator Andrew Wheeler appeared before a House Appropriations Subcommittee and fielded questions about the rising cost of Renewable Identification Numbers, or RINs, credits which allow oil refiners unable to blend a percentage of biofuels into their final output to remain in compliance with EPA's renewable fuel standards.
As I think you probably know, there's no economic benefit from the production of RINs. They've gone up something like 400% in the last year. They affect a couple of refineries in my district, small refineries that has an enormous influence. Can you give me some hope very quickly on RINs and your awareness of that, and if there's something we can do to reduce the upward pressure on those?
Well, they've gone up in the last couple of weeks because of the 10th Circuit Court decision on the small refinery exemption.
In late January, the U.S. Court of Appeals for the 10th Circuit struck down 3 small refinery exemptions improperly granted by EPA. The ruling stems from a 2018 challenge brought against the federal agency by a handful of agriculture and biofuel groups. USDA tacked onto that momentum this week as well.
We'll be doing a higher blends infrastructure incentive program of $100 million in helping the retailers to move to infrastructure that can support ethanol E15 and B20 and higher.
But Bloomberg News reported late this week the Trump administration is expected to appeal the 10th Circuit ruling. And for some in the renewable industry, past performance at EPA is no indication of future results.
You know, there's lies, damn lies, and then there's statistics.
Monty Shaw is executive director of the Iowa Renewable Fuels Association, which advocates for corn-based ethanol and soy-based biodiesel.
The oil guys don't want to let any higher blends in. This is a market forcing mechanism that says, hey, you're going to have to allow consumers the option of these higher blends. Some will buy it, some won't, but this will, and the RINs will, are basically the market incentive to do that. RINs are still probably half or less of what they were before these illegal exemptions were granted. So are they more than they were when the entire RFS was being gutted out the back door by these exemptions? Yes, but they're supposed to be. That's the economic incentive and reward for the people who move us forward and comply with the law.
For Market to Market, I'm Josh Bittner.
Next, the Market to Market report.
The commodity markets chewed on weather and currency values in South America, limited Chinese buying, and the continued effect of the coronavirus. For the week, May wheat lost 9 cents and the nearby corn contract rose 8 cents. The May soybean contract lost only 2 cents after trading as much as 18 cents higher earlier in the week. May soybean meal lost 50 cents per ton. May cotton bumped up $1.30 per hundredweight. Over in the dairy parlor, April Class 3 milk futures lost 16 cents. The livestock sector was mixed. April cattle dropped $1.83. April feeders shed $2.65, and April lean hog contracts put $3.65 to the black. In the currency market, the U.S. dollar index plunged 215 ticks. April crude fell $3.82 per barrel as OPEC and Russia failed to make a deal on production cuts. COMEX gold skyrocketed $98.80 per ounce, and the Goldman Sachs commodity index dropped more than 14 points to finish at $344 even. Joining us now to offer insight on these and other trends is one of our regular market analysts, Elaine Kubb. So good to have you back.
Sure thing.
So it was a very volatile week in terms of the outside commodity sector and the stock market because of the coronavirus, the Fed cutting interest rates. When does the ag commodities sector divorce itself from all of that noise?
Yeah, there's that argument to make that no matter how sick anybody is anywhere in the world, you still got to eat, right? That you would still have these food commodities, ag commodities, be relatively resilient to some of that influence that the stock market certainly respond to, as in Peter's story suggested, we have the entire supply chains being disrupted. So to some extent, I do think that commodities are oversold during this panic, but there has also been some legitimate demand destruction, and I think it really just depends commodity by commodity. We have to go through and really evaluate how much demand destruction is real based on this coronavirus story and how much of it is just an oversold or a panic-based scenario.
So we do have a question from one of our viewers. Mitch from Hull, Iowa, wants to know where you see the biggest opportunity, once the coronavirus fears maybe subside in the commodity markets.
Okay, biggest opportunity other than refinancing your mortgage at record low interest rates. As far as a real trading opportunity, I like looking at the meat complex right now. I think if we talk about this idea of a commodity market, a food commodity market that really doesn't have domestically demand destruction from coronavirus yet, you could argue perhaps that folks aren't going out to eat at restaurants quite as much, but we don't have evidence of that. I think that the meat complex has been severely oversold, and a lot of that has been speculative activity.
So we have a USDA report, WASDE numbers coming out next Tuesday. Do you think there's any demand adjustments for coronavirus that will be put in the report?
I would be very surprised. I think that would be very out of character for the USDA to kind of step out on a limb without any, really up-to-date or really certain numbers to base that sort of adjustment on. I think, and the expectations of all of the analysts going into that report suggest that they would be cutting the ending stocks, and so we are not expecting to see that sort of an influence on that March USDA report just yet.
Great. All right, so let's talk about the wheat market. Elaine, from the January 22nd highs, we've dropped about 75 cents in May. Chicago wheat down 62 cents in Kansas City wheat. I know the funds have been liquidating a long position that they had there. Is there any reason for them to stop doing that?
Well, again, in my opinion, if we're looking commodity by commodity, which is justified to react to these scares, wheat is actually a staple grain. Your price demand elasticity for wheat is much less than it would be for certain other foods. So wheat, in theory, should be more stable. You can also look, just sort of fundamental supply and demand issues, but this time of year is sort of tricky to do that for wheat.
So we also have an inverted market, both for Kansas City and Chicago. What is that telling us right now, Elaine?
Well, it would tell you, and this is true for corn also, is that there is, real demand for feed grains right now, and that the prices have not really reflected that in the futures market, reflected the same degree that the cash market is really demanding to see that feed grain come physically to the market.
And let's talk about corn as well. We've had a little rebound off the contract lows last Friday. We had a little bit higher weekly close here. But that market as well, the funds are short, and they keep kind of pushing that side of the market. What do you see ahead?
Yeah, corn has really bounced along with whatever the headline of the day has been. During the coronavirus, when crude oil was falling so drastically, corn really followed along. And then when we had the Fed rate cut that brought stock markets bouncing back up just a little bit this week, corn seemed to follow along with that, which again is not really justified for corn as a commodity. Commodities in general should not respond to interest rates to that degree. Other asset pricing does. Certainly, if you're looking at a future income stream, any future income stream for land or a house or any sort of asset like that, it certainly does respond to a cut interest rate. I mean, that's just arithmetic. But commodities should, in theory, only trade according to their supply and demand. And, like I mentioned, the actual demand for feed grains, certainly as you suggested with that inverted structure, and for feed grains just generally, when we have a world where in the United States, certainly we haven't had big culls of animals. We still have just the same amount of animals eating this feed grains. Corn should not be responding to those headlines to this degree, in my opinion.
So let's talk about another disconnect, Elaine, the futures versus the very strong cash basis levels that we've had for weeks now.
Months.
Months, yes, exactly.
This has been the case ever since, the countryside seems to believe that we don't have as much corn, and the cash buyers are apparently not able to get that corn from the farmers, or not to see as much of it in the supply chain as they would like to see. And you do see it reflected, not necessarily in the futures market, but the cash bids are inverted all the way past May, all the way to the new crop. So that suggests to me that certainly there's not as much corn out there as people would like to see or have their hands on. And it's very interesting to drill down exactly where that's happening. You see the most appetite for that cash grain certainly still in the eastern corn belt, where you've still got basis values of plus 20 over the May contract. And some pockets of the western corn belt too, where there's a heavy amount of animal feeding. There's a lot of appetite to get that physical grain to the end users.
Plus, we had late test weight corn, and so we're probably feeding more, aren't we?
Yeah, so when you talk about the supply and demand reports, I don't think this is something that will show up on the March report. It could be until next January. But there's certainly opportunities for the USDA to have to go into their tables and totally readjust the volume and the weight of the grain that is actually out there.
So soybeans, the biggest thing besides coronavirus this week has been the record low the real has had to the US dollar, and that's really been crushing that soybean market and our competitiveness, hasn't it?
Yeah, continually record low, and we've had a series of record lows. It just keeps lower and lower, but this week that trend of lower trade in the Brazilian real really steepened. There was 2 days when it lost 3% in just 2 days. So absolutely, when you look at the competitiveness of soybeans coming out of the port in Brazil, they're going out of there pretty fast. They've got a record large crop, and those prices are really favorable on the domestic or on the international market simply because of that currency trade.
So let's also talk about the fact that the February crop insurance revenue prices were set here. And in fact, soybeans at $9.17, that's down 37 cents from a year ago. Corn at $3.88, down 12 cents. What does that incentivize in terms of farmers when they go to plant this spring? And what about the corn-soybean ratio? Talk about that as well.
Yeah, just to do pure arithmetic from the numbers you gave, that's a 2.36 to 1 price ratio of soybeans to corn. Ordinarily, just historically, statistically, you'd expect it to see more like 2.45 to 1. That would be the usual relationship, which accounts for the different yield scenarios. It accounts for the different feed values of those two crops. So to see soybeans at 2.36 to 1 compared to corn suggests that soybeans are not going to be your big buyer of acres as we go into this battle for acres scenario. And I will just say one more thing about those crop insurance reference prices. Before we had this coronavirus issue that brought down grain prices right at the end of February, that last week of February, because it had gotten into Europe, all of a sudden the commodities started responding. Before that, the corn crop insurance price would have been $3.90, and the soybean crop insurance price would have been like $9.19. So we did lose, in my opinion, about 2 cents on our crop insurance reference prices, which are important for the entire year of trade, not just a minuscule period of time. Those are going to be with us all through this marketing year, and we lost 2 cents on each of those crops due to this coronavirus scare.
Yeah, this is like the lowest level since 2016, I think. So
yeah, these are not really encouraging.
No, not at all. So the cotton market has also been embroiled here in the coronavirus concerns as well. And I know USDA at the Ag Outlook Forum thought that ending stocks might be actually a little bit lower, but that export pace would be pretty decent for the year. That's going to be pretty hard to meet, though, isn't it, with coronavirus?
Right. Cotton is absolutely a poster child of reacting to the international supply chain issues and the international coronavirus concerns. We are seeing basically a one-to-one daily pattern of cotton following along with the stock market or the equity market's concerns about coronavirus.
What about cattle? That was a train wreck of a week here. Live cattle futures on Friday gapped into new contract lows again. How much farther do we have to go here in this market lower, do you think?
I don't want to step in and catch a falling knife, and I can't really put a time frame on it, but you're right about them being super low. These prices are actually lower than they were after that Holcomb, Kansas fire.
Right.
We've dropped down to lows that, in my opinion, are not justified whatsoever by the real supply and demand of U.S. domestic beef consumption.
And in fact, that's pulled the cash market down. Right.
Absolutely, it has. It's the futures traders going in there. The volume of futures trade this past week is something like 133% higher than it was during that same week last year. It has been a huge volume of speculative money market, managed money going in there and trading these livestock futures, bringing them down based because of the coronavirus. Sure, that's fine. But I think that then it's the tail wagging the dog when the cash traders go out there and their prices are 113, 180 dressed. That 180 dressed price is $4 to $6 lower than last week. So a $4 to $6 drop week to week, that's a big movement in the cash market.
So the funds are pretty much out of all of their length and probably short now in this market, Elaine?
You know, I didn't get a chance to see the Friday afternoon numbers, but yeah, I mean, it could certainly go that way given that huge volume of trade.
Now, feeder cattle, the cash market's held up a little bit better out in the country versus the volatility that we've seen in the futures, right?
Right, because legitimately, the ability to go out and fill a feedlot right now is not being affected here in the United States yet by this coronavirus story. It shouldn't be. So we do see some sales. There was a sale in Kansas that I think was $1 or $2 higher than last year. There's sales up in our home state of South Dakota where you had a weighted average of 142, and of course you've got northern basis. But the CME cash index is 133, not great, but still better than how extremely the futures fell apart here on Friday.
Yeah. So let's also talk about the hog market holding up better, actually, than the rest of the commodities sector. What all did you attribute that to?
Well, number one, against legitimately in the United States domestically, there is still demand for hogs. You've got daily slaughter rates of like 495,000 a day, just huge. Certainly still bigger than they were last year at this time, showing the expansion of that industry. So that's great. But it may also be, in my opinion, I think that the speculative story for hogs might be a little bit bullish. You might have funds and investors looking at the possibility of China coming in and buying U.S. pork, or certainly buying North American pork eventually. 3 months down the road, 6 months down the road. I know we always say this about hogs. Right. It's always a story for 6 months down the road. But I think that might be why you're seeing some of the support in the futures market.
Do you think that premium is justified, especially in the deferred months? Because that's where we've been putting it, and we haven't necessarily seen that China business come to fruition.
I know, and it just keeps on being this kicking the can down the road. But we do see, animal culls going on in China, not just hogs, but also chickens, because they cannot get the soybean meal logistically through their supply chain where it's needed. So there's just eventually, when the Chinese consumer comes back and needs protein, needs to go to the market and buy protein, they will need to get it from somewhere.
So do you get a big relief rally after the coronavirus goes away in both cattle and hogs because of that meat demand, or?
I would like to see all of the meat futures markets have a recovery before we see the coronavirus go away, because the coronavirus could be with us for a year. I mean, who knows how long this may take.
And we have got a lot of gap areas on the charts. Do we go back and fill those in cattle and hogs too?
Yeah, so I'm about the most skeptical skeptic there is about technical trading things, but the gap things, those are a mechanical reason. There's going to be, bids and asks that are just left there hanging, that the market or the chart does need to come back up and fill those gaps.
All right. We always appreciate your time. Thanks so much, Elaine Kub. Well, that wraps up the broadcast portion of Market to Market, but we will keep this conversation going on Market Plus, where we'll answer more of your questions. You can find it on our website at markettomarket.org. A reminder, many PBS stations are in fundraising mode. Please support your local station that carries Market to Market. You'll be investing in the news, reporting, and timely market analysis you trust. Join us again next week when we'll continue to explore the effect of the coronavirus on the commodity markets. So until then, thanks for watching and have a great week.
Market to Market is a production of Iowa PBS, which is solely responsible for its content. Pioneer Hybrid International is a proud sponsor of Market to Market.
Sukkot Manufacturing Company, providing equipment and buildings to store and condition grain to help farmers adjust to market swings. We build drying, moving, and storage equipment designed to preserve the quality of their crops. Sukkot Manufacturing, store now, profit later.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.